Stephen Duneier, you write and speak a lot about cognitive science when it comes to investing. So before we talk about allocating assets, can you tell me how cognitive science affects investing?
Sure. So people think of cognitive science, behavior theory, decision analysis more about how we make irrational choices. But the truth is, it's really just about bias. It's about losing your objectivity. That's what creates the irrationality. So for me, as an investor, the important point is to maintain objectivity, and I do that through a process and structure.
All right. Well, one thing you've been writing about is how the Fed is powerless. That's the choice they're making in your view. Can you explain that to me? Because everyone tells me not to fight the Fed.
The Fed they've got their dual mandate. Everybody knows that. But fundamentally, the Fed is no different than any other institution or corporation. They are in the business of behavior modification of their target audience. What's important to understand is their target audience has changed radically. So the whole reaction function between the Fed's tools and what they're hoping for as behavior out of their target audience, it's different. And so they've become what I believe essentially impotent, and most of it is a function of wealth disparity and income disparity, changing the incentive system of their target audience.
And the other thing they're doing is they're making everyone buy stocks because they're keeping rates, I suppose, artificially low. Now, you say that we're in a period of extreme risk aversion, but I thought that everyone going into stocks, that's making things more risky.
Look at the correlation between the S&P and all of the other traditionally risky assets. It's collapsed. The S&P should no longer be seen as a risky asset or reflective of a risky asset like emerging markets are or commodities are, let's say. Fundamentally, the markets have changed. There are really only two pieces of evidence that you can point to as making a case for the fact that we're in a risk-seeking environment. One is stocks going up, but we've seen that before in history where they'll go up even during a risk-averse moment. And the other is spread compression. But I think what people are missing when you look at spread compression instead of ratios of returns, you're sort of getting lulled into this belief that we're all in risk-seeking mode. The truth is, stock market has gone up, but very few people have actually participated in it.
All right. Does that mean I should stick with the S&P 500? Is that your investment advice?
Yeah. The definition of inertia is things essentially go as they will go and as they have been until it meets some unbalanced force. The unbalanced force, my belief, based on my, this understanding that the Fed is essentially powerless, the Fed is not that unbalanced force. What has worked going back to 2011, I believe is going to continue to work for some time to come until we get some truly institutional changes, and those are going to be more federal than they are monetary.
Can you give me an example of such a catalyst that will unbalance the current ecosystem as you see it?
Yeah, the things that will break the trend of income and wealth disparity. So the two key things will be more power for labor unions, and the other is taxation. Those are the only two fundamental changes that will change things.
Not Greece, not China. It's going to be those things that affect directly the U.S. economy.
Yeah, China's actually less important than it used to be. China was only really important because of its urbanization process. That urbanization process reached a peak in 2010, has turned the other direction, which is why you've seen commodities come off since then.
All right. Thanks a lot, Stephen.
Thank you.
Thank you for watching The Street.